Amazon stock plummets. Is this a buying opportunity? Imagine waking up to find that your investment in Amazon has taken a significant hit. Is this a temporary setback or a sign of more challenging times ahead for the e-commerce giant? Let's dive into the recent events that have sent Amazon stock plummeting and explore what this means for long-term investors. As of 3:28 p.m. ET on Friday, Amazon's shares, AMZN, have dropped by a staggering 8.3%. This decline is part of a broader market downturn, with the SP 500 and Nasdaq Composite losing 1.7% and 2.3%, respectively. But here's where it gets controversial. The drop in Amazon stock is not just a reflection of the overall market sentiment. It's also a direct response to the company's latest financial report and external economic pressures. Amazon recently released its Q2 financials, and while the numbers beat many of Wall Street's expectations, they fell short in a few critical areas. The company reported $1.68 per share on $167.70 billion in sales, surpassing the expected $1.33 per share on $162.09 billion. However, investors were particularly focused on the growth of Amazon's cloud business, Amazon Web Services, AWS, and how it stacks up against its competitors. AWS saw an 18% year-over-year growth, which, while impressive, pales in comparison to the 39% growth of Microsoft's Azure and the 32% growth of Alphabet's Google Cloud. But this is the part most people miss. Despite the slower growth, AWS remains the dominant player in the market, with CEO Andy Jassy emphasizing that the second largest competitor is only about 65% the size of AWS. Adding to the market's woes is the news of additional tariffs signed into law by President Trump. On August 1st, Trump updated reciprocal tariff rates for various countries, ranging from 10% to 41%. Markets had anticipated another extension, and the sudden imposition of these tariffs sent stocks tumbling across the board. Amazon, with its heavy reliance on international trade, was hit particularly hard. The combination of the tariff news and the somewhat underwhelming Q2 report has left investors wary. But here's a question to ponder. Is this a buying opportunity for long-term investors, or a sign that tougher times are ahead for Amazon? Despite the recent setbacks, it's crucial to remember that Amazon remains an incredibly profitable company with substantial growth potential. The company's innovative strategies and expansive market reach continue to position it as a leader in the tech industry. So, what do you think? Is now the time to invest in Amazon, or should we brace ourselves for more volatility? Share your thoughts in the comments below, and let's spark a lively discussion. Amazon stock drops after Q2 earnings, mixed outlook. AI cloud struggles reveal investor concerns. In a surprising turn of events, Amazon stock took a significant hit, plummeting after the tech behemoth reported its second quarter earnings. Despite surpassing expectations with its sales and earnings, the company's mixed outlook and the underperformance of its cloud business, Amazon Web Services, AWS, cast a shadow over its otherwise robust performance. This scenario has left investors and analysts scratching their heads, wondering if there's more to the story than meets the eye. But here's where it gets controversial. Could Amazon's struggles in the AI cloud sector be a sign of deeper issues, or is it merely a temporary setback in an otherwise dominant market position? Seattle-based Amazon, in its earnings report released late Thursday, announced an adjusted earnings per share of $1.68 for the quarter ending June, marking a 33% increase from the previous year. This figure comfortably surpassed the $1.33 per share that analysts had forecasted. Moreover, the company's sales surged by 13% to $167.7 billion, exceeding the $162.2 billion analysts had estimated. However, the mixed outlook and the underperformance of AWS have raised eyebrows, leading to a drop in Amazon's stock price by 8.3% to close at $214.75 on the stock market today. The closely monitored AWS, Amazon's cloud business, reported a 17.5% growth in revenue to $30.87 billion in Q2, which, while beating analyst estimates, was overshadowed by the 39% growth of Microsoft Azure and the 32% revenue jump by Google Cloud over the same period. This underperformance in the AI cloud sector has sparked concerns among investors and analysts, leading to a significant drop in Amazon's stock price after hours on Thursday. During a conference call with analysts, Amazon's CEO, Andy Jassy, addressed the finance person narrative that Amazon was lagging behind in generative AI. Jassy maintained that the AI field is still in its early stages, and that Amazon's cost advantages and extensive client base would eventually pay off. However, his comments did little to assuage investor fears as Amazon's stock price continued to slide. The mixed results from AWS and the company's conservative profit outlook have contributed to the stock's decline. This is the second consecutive quarter where Amazon's stock has been negatively impacted by the company's operating income guidance. In Q1, Amazon provided a wider-than-expected range for the second quarter operating income, which missed estimates and fueled concerns about the impact of tariffs on imports on Amazon's profits. Despite beating its guidance in Q2 with an operating income of $19.2 billion, prior to the earnings report, Amazon's stock had gained 1.7% in regular trading, buoyed by strong results from cloud rival Microsoft. As of Thursday's close, Amazon's stock was up roughly 7% year-to-date, trailing the nearly 8% gain of the S&P 500. However, this is a significant improvement from earlier this spring when Amazon's stock had slumped steeply. The stock has since rebounded with an 18% gain from May through June following the U.S. easing of tariffs on Chinese goods. Despite the recent volatility, Amazon's stock has shown resilience, breaking out above a cut-with-handle buy point of $214.84 on June 9th. The stock has since edged higher, supported by a strong IBD composite rating of 95 out of a possible 99. This rating combines 5 separate proprietary ratings into one, highlighting the best growth stocks with a composite rating of 90 or better. In conclusion, while Amazon's second quarter earnings report showcased its strong sales and earnings, the mixed outlook and the underperformance of AWS have raised concerns among investors and analysts. The company's conservative profit outlook and the ongoing challenges in the AI cloud sector have contributed to the stock's decline. However, Amazon's stock has shown resilience, supported by a strong IBD composite rating and a recent rebound following the easing of tariffs on Chinese goods. The future of Amazon's stock remains uncertain, but one thing is clear: the company's performance in the AI cloud sector will be closely watched in the coming quarters. Amazon stock drops 8%. Key earnings takeaways. Amazon's stock plunges 8% after earnings report, unpacking the key insights. Amazon CEO Andy Jassy stands during an Amazon Devices launch event in New York City, US, February 26, 2025. Reuters, Brendan McDermott. Brendan McDermott, Reuters. Amazon, the tech giant, released its second quarter earnings report on Thursday, which, while beating expectations on most metrics, failed to impress Wall Street. The stock took a significant hit, closing down 8% on Friday and is down roughly 2% year-to-date. The primary culprits? Weaker-than-expected profit guidance and underwhelming cloud growth. But here's where it gets controversial. Despite these setbacks, the report wasn't all doom and gloom. Amazon showcased strong revenue and profits, steady retail growth, and a 23% increase in advertising sales. Additionally, the company offered a promising revenue forecast for the current quarter. So, why the sell-off? Let's dive into the key takeaways. AI spending boost. Amazon reported a staggering $31.4 billion in capital expenses for the last quarter, with expectations to maintain a similar spending pace in the second half of the year. This is a significant jump from the first quarter's $24 billion. If this trend continues, Amazon could spend upwards of $118 billion on capital expenditures this year, a substantial increase from its previous forecast of $100 billion. This massive investment is primarily directed towards building out tech infrastructure to support the burgeoning demand for artificial intelligence. Amazon isn't alone in this AI spending spree. Meta recently boosted its capital spending forecast to a range of $66 billion to $72 billion, while Google's parent company, Alphabet, raised its capital spend to $85 billion this year. The big question on everyone's mind is, when will these substantial AI investments start paying off in terms of revenue or profit? Amazon CEO Andy Jassy hinted that the company's progress in AI has improved its operational efficiency and business growth, but he offered few specifics. Amazon has previously stated that generative AI is contributing revenue to AWS at an annualized rate equivalent to multiple billions of dollars. During a conference call with investors, Jassy pointed to Alexa Plus, an upgraded version of its digital assistant, as a potential way to monetize AI. The service, which launched in early access in late March, is $19.99 a month or free for Prime members. Jassy suggested that as more functionality is added, there could be a subscription element beyond what is currently offered. Jassy reiterated that it's very early days in AI development and adoption. This begs the question, are investors being too impatient, or is Amazon's AI strategy not as robust as it seems? Cloud rivals Amazon Web Services, AWS, continues to dominate the cloud infrastructure market, but it's facing stiff competition from Microsoft Azure and Google Cloud. While AWS grew its revenue by 18% year-over-year, just beating Wall Street's estimates, Microsoft and Alphabet reported cloud growth rates of 39% and 32%, respectively. This has led to speculation that AWS might be falling behind in generative AI. Analysts have been questioning why AWS's cloud business isn't growing as quickly as its rivals. Morgan Stanley analyst Brian Nowak suggested there's a narrative that AWS is falling behind in generative AI, with concerns about share loss to competitors. JP Morgan analyst Doug Anmuth noted significantly faster cloud growth among the number 2 and number 3 players in the space. Jassy defended AWS's position, stating that while growth rates fluctuate, AWS still has a meaningfully larger cloud business. He also took a subtle jab at Microsoft over a recent worldwide attack on its SharePoint collaboration software, emphasizing the security differences AWS customers experience. However, these comments didn't seem to reassure all investors. Bernstein analysts described the tone as less than great, and Amazon's explanation for its competitive positioning as less constructive than peers. Tariff risk better than feared in May. Amazon warned about potential uncertainty linked to President Donald Trump's shifting tariff and trade policies. At the time, products imported from China faced a steep 145% levy, threatening to drive up costs for Amazon vendors and third-party sellers. However, the US and China have since reached a truce, with China now facing a 30% combined tariff rate. Amazon's latest earnings report indicates that the company is navigating these tariffs and shifting trade policies better than Wall Street had feared. Sales in its online store topped analysts' projections and grew 11% year-over-year, while seller services revenue also beat expectations. The number of items sold in Amazon's online and physical stores jumped 12%, suggesting that consumer demand remains healthy despite economic uncertainty. Amazon's third-quarter sales forecast, which implies 13% growth at the high end, suggests that tariffs appear to have been effectively absorbed by suppliers, merchants, and customers. Jassy struck a positive but cautious tone, acknowledging the uncertainty surrounding future tariffs, especially with China. He noted that it's hard to predict who will end up absorbing the higher costs. A deal between the US and China hasn't been finalized, and the two countries have until August 12 to reach a final agreement. So far, Amazon has managed to weather Trump's trade war without seeing diminished demand or broad-scale price increases. But will this trend continue? Only time will tell. And this is the part most people miss. While Amazon's stock took a hit, the company's underlying performance shows resilience and strategic investment in AI and cloud infrastructure. The real question is, will these investments pay off in the long run? And how will Amazon continue to navigate the complexities of global trade and competition? What do you think? Will Amazon's AI and cloud strategies ultimately pay off? Or are there too many uncertainties ahead? Share your thoughts in the comments below.